Hey everyone, and welcome. For a lot of small business owners, there's this classic mystery that lives in a shoebox, just overflowing with receipts. So today, we're going to put on our detective hats and solve a case that stumps so many people: how to figure out if you actually made a profit.
I mean, think about it. You've worked your tail off all year, but your financial records, they're not exactly perfect, are they? They're in a shoebox. So how in the world do you find the profit that's hiding in all that paper? Don't worry, we're going to figure it out together.
So let's officially open the case file on what I'm calling the shoebox accounting mystery. It's a super common situation, and the good news? You already have all the clues you need to find your bottom line. You just need to know where to look.
So what's our crime scene, so to speak? Well, in the accounting world, it's called incomplete records. And hey, this has nothing to do with being sloppy. It's just the reality for so many entrepreneurs who are busy, running their business. You're probably keeping track of cash, maybe who owes you money, and that is exactly what we need to get started. Our mission today, should you choose to accept it, is not to build a perfect, complicated set of books from scratch. Nope, it's much, much simpler. We are here to find that one single crucial number, your profit or your loss, using only the clues that are probably sitting in that shoebox right now. All right, so every good investigation starts by surveying the scene, right? You got to collect the evidence. For us, that means taking what we'll call a financial snapshot of your business at a very specific moment in time. This is our starting point.
And the main tool we're going to use is something called a statement of affairs. Just think of it like a simplified balance sheet. We're basically dusting for financial fingerprints. We're listing out everything the business owns, those are its assets, and everything it owes, which are its liabilities. Simple as that.
So take a look. On the asset side, what you own, you've got things like cash, your inventory, maybe a machine. And on the liability side, what you owe, you've got a bank loan, maybe some money you owe to a supplier. Now, the magic happens when we subtract what you owe from what you own. That number at the very bottom, that's your capital. It's the key figure that makes everything balance out, and it represents your personal stake in the business.
This right here is the golden rule for this entire mystery. Capital equals assets minus liabilities. That's it. This is basically your business's net worth at that one specific moment. You're going to want to remember this formula. It's the key to everything.
But here's the thing. One snapshot in time is just a single clue. The real detective work, the fun part, begins when we compare two of them, one from the beginning of the year and one from the end. That is how we're going to see the full story unfold.
Okay, here's our first piece of evidence. Exhibit A. Let's just say at the start of the year, your business's capital, its net worth, was $100,000. Got it? That's our baseline.
Now, fast forward through a year of hard work. You take another snapshot, and your capital is now $132,000. You can see it's grown. That looks promising, right?
Now, I know what you're thinking. Awesome, so the profit is just $32,000, right? The difference? Well, hold on a second. Any good detective knows there are always a few twists in the plot, and this case is no different. It's not quite that simple. The two big twists we have to look out for are the movements of money between you, the owner, and the business itself. We have to account for any money you took out for personal use and any fresh money you decided to put in. These two things can completely throw off our calculations if we ignore them.
Okay, let's break down these two plot twists. On one hand, we have drawings. That's any business cash you used for personal stuff. Since that money left the business and wasn't a business expense, we have to add it back to see the real profit. Then there's fresh capital. This is your own personal money that you put into the business. Since the business didn't earn that cash, we have to subtract it out to find the true profit. Makes sense, right? All right, we have gathered all of our clues. We have our opening capital, our closing capital, and we've identified our two main suspects, drawings and fresh capital. It is time, my friend, to bring it all together and solve this thing once and for all.
Here it is, the formula that solves the entire mystery. First, you start with your closing capital. Step 2, you add back any drawings you took. Step 3, you subtract any fresh capital you put in. And for the final step, you subtract your opening capital. Whatever is left over, that's it. That is your true profit that we've been hunting for. Now, theory is great and all, but let's solve a real case to see how this works. I want you to meet Raju. Just like many of us, he doesn't keep perfect books, but he has the exact clues we need to find his profit. Here is Raju's case file. He ended the year with $12,500 in capital.
He took out $3,000 in drawings, he added $3,750 in fresh capital, and he started the whole year with $10,000. Look at that, we have everything we need.
Let's just plug Raju's numbers right into our formula. We take his closing capital of $12,500 and we add back his drawings of $3,000. Okay, that gives us an adjusted total of $15,500. Now for the other side of the equation. We take a starting capital of $10,000 and we add the fresh capital he put in for a total of $13,750. The profit is just the difference between those two numbers.
And there you have it. The mystery is solved. After all those adjustments, Raju's true net profit for the year was $1,750. Case closed. So, what did we actually learn from this whole investigation? Well, the biggest takeaway is that you absolutely do not need perfect books to get a handle on your profit. You just need to create that statement of affairs at the start and end of the year. Remember that capital is just assets minus liabilities, and crucially, always adjust for your drawings and any fresh capital. It's a powerful little technique called the capital comparison method, and now you know exactly how to use it. Now, before we wrap this up, there is one final really important clue from our source material. You got to remember, this method gives you a very powerful estimate, but because we're working with incomplete records, it's not going to be as laser precise as a full-blown double-entry accounting system. It's a fantastic tool for sure, but it's important to know its limitations. Finding your estimated profit is a huge first step, a major win. But you know what? The detective work doesn't really stop there. The next mystery is hidden in all the little details inside that shoebox. What story are all those receipts telling you about where your money is really going? That, my friends, is the next case to crack.